We all know leverage is the secret sauce in multifamily investing. It's how investors scale and maximize their returns. But what happens when it starts working against you? When your cost of borrowing exceeds your property's returns. If you get it right, leverage can skyrocket your wealth. But if you don't, it can suffocate the cash flow and kill the deal before it even starts. In today's video, I'm breaking down positive and negative leverage in multifamily investing, how to spot it, use it to your advantage, and avoid the major pitfalls. If you stick around till the end, I'll walk you through a real-life example so you can apply this knowledge to your next deal. Let's dive in. Leverage is simple. It's using borrowed money to buy real estate. In the multifamily space, most investors take out loans to finance the deal rather than paying all cash. Why? Because the right leverage strategy can help you scale faster and maximize your returns. Let's say you're buying a $1 million multifamily property. Instead of paying $1 million in cash, you put down $250,000 and finance the rest with a $750,000 loan. If that property cash flows well, your return on equity is magnified because you're controlling a large asset with less of your own money. But here's where it gets interesting. Leverage can work for you or against you. That's where the concept of positive and negative leverage comes into play. Positive leverage happens when the property's return, measured by the capitalization rate or cap rate, is higher than the interest rate on your loan. This means your investment is working harder than your debt, generating excess cash flow. Let's take a look at a quick example. Let's say you purchase a property for $1 million. That property is generating an annual net operating income, so your revenue minus expenses, of $80,000 per year. This gives you a cap rate of 8%, which is the $80,000 divided by $1 million. Now, let's say you are taking a loan on that property with an interest rate of 5%. In this scenario, since the cap rate 8% is higher than the interest rate of 5%, the property is producing more cash flow relative to its borrowing cost. This is a winning situation. Investors in positive leverage scenarios typically see higher returns on equity, stronger cash flow, and greater long-term appreciation. Now let's talk about the flip side, negative leverage. This happens when your interest rate is higher than the cap rate. Instead of increasing your returns, the debt you put on the property is actually eating into your profits, which is the scenario we've been seeing with a lot of deals lately in this high interest rate environment. Let's take a look at an example with negative leverage. Now assume you purchase the same property for $1 million. This time, the net operating income on that property is only $50,000 per year, which gives you a cap rate of 5%. So that's $50,000 divided by $1 million purchase price. Let's assume the lender quoted you an interest rate of 6%. In this scenario, the property is producing a lower return than the cost of borrowing. This means instead of boosting your cash flow, leverage is actually reducing it. So we say leverage has a negative impact on our overall returns. The question then is, why would anyone accept negative leverage? Sometimes investors bet on future appreciation, rent increases, and a value add strategy to eventually flip that negative leverage into positive. But this is a high risk move that requires precise execution. Before taking on debt in any multifamily deal, here are 5 key checks to make sure you don't end up with negative leverage. 1. Compare the cap rate on the property to the interest rates. Always aim for a cap rate higher than your loan rate. 2. Understand market trends. Keep an eye on rising interest rates. They can flip positive leverage negative overnight. 3. Assess NOI growth potential. If rents are below market, can you increase them to improve your leverage? 4. Always stress test your deal. What happens if rents don't grow or vacancies increase? 5. Analyze loan structures. Fixed versus variable rates matter. Adjustable loans can shift leverage unexpectedly. With all this information, how would an investor apply this in practice? Let's take a look at what this looks like in Excel. Let's assume an investor purchased a multifamily property for $1 million. And on this property, they used the loan, assume the loan to value was 70%. So the debt on this property is 70% of the purchase price. Actually, let's make this 75%. So it mimics the example we looked at before. So the out-of-pocket cost, and this is a very simplified example. So that investor, we put in $250,000 of their own money. What's their annual loan payment? First, let's take a look at the debt. Debt amount is $750,000. Interest rate in today's market, let's assume, I'm going to say 6.4%. Amortization period, let's say 30 years. So that's 30 times 12, 360 months. The annual loan payment, we use the PMT formula. Our rate is 6.4% divided by 12, because that's the annual rate. Number of period is 360, or we can do 30 years times 12, either one. And our present value, that's the loan amount. That's negative loan amount. And this is the monthly payment. So our annual debt payment multiplied by 12. That investor is paying a total of $56,295 each year in debt service. When we're thinking about leverage, the true definition is comparing the cap rate to the loan constant. And the loan constant is the annual debt service divided by the total loan amount. In this example, the loan constant is 7.51%. If the cap rate, which is your theoretical return on investment, is greater than the loan constant, the cost of borrowing, then that's considered positive leverage. If the cost of borrowing is higher than the cap rate, then that's considered negative leverage. Let's take a look at the cap rate for this property. We know we purchased it for $1 million. Let me look at property level. Let's say this property, the effective gross income, let's say $100,000. For expenses, let's assume a Class C property. We're going to assume 50% expenses. So our total expenses is 50% of the revenue the property is generating is $50,000. A net operating income, or NOI, is the effective gross income minus the expenses, so it's $50,000. That's NOI. We have our purchase price and we have our net operating income, so we can calculate what that property cap rate is. Your cap rate is just the net operating income divided by the purchase price or the value of that property. This is in percent. The cap rate based on that purchase price and the net operating income is 5%. What this is telling us is that if we paid all cash for this property and our cash flow was $50,000, our return on our investment would be 5%. When comparing leverage, let's start with using the true definition of leverage. We're going to say use the if formula, if the cap rate, so our return on investment, is greater than the loan constant, let's call this positive leverage because our return is greater than our cost of capital. But if it's not, then we'll call this negative leverage. This is a very simplified example. A lot of times in the multifamily space, investors would just use the interest rate. They'll compare the interest rate to the cap rate to determine what the leverage is. But the true definition of leverage is comparing the cap rate to the loan constant. And the loan constant is the annual debt service divided by the total loan amount. In this example, we're saying that if the cap rate is greater than the loan constant, it's positive leverage. If it's not, then we're going to call it negative leverage. Let's put formatting on here. If that cell contains negative leverage, turn it red. However, if it contains positive leverage, I'm just going to duplicate this, change this rule, turn it green. What is this telling us? If we look at this practical example, say this is a deal that you're looking at. You purchased it for $1 million. You got a loan with an LTV of 75%. The lender's bringing in $750,000. You put in $250,000 of your own money into this deal. The lender gives you an interest rate of 6.4%. With a basic definition, if we compare that interest rate to the cap rate, we can see that the cost of borrowing is actually higher than our projected returns if we paid all cash for that property. But the true definition of leverage is using that loan constant. because that loan constant can be impacted by the amortization length as well as the interest rate. If the cap rate is higher than the loan constant, then that's positive leverage. But if the cap rate is lower than the loan constant, then it's considered negative leverage. The question you might be asking is, why would an investor pay for a property with negative leverage? Well, let's take a look. What if in year one, that property is only generating a net operating income of $50,000? But through your comp analysis, speaking to your property manager, you realize there's potential in this deal through a value add strategy. By doing a value add strategy, by year three, let's say stabilization, you're able to increase that effective gross income to $150,000. What does that look like? If you increase that effective gross income to $150,000, cut your expenses, let's say we're becoming more efficient, let's cut this down to 43%. So now we increase the effective gross income from $100,000 to $150,000, and we reduce our expense ratio from 50% to 43%. Now there's an increase in our net operating income. If you look at that property cap rate, it's now 8.55%. Comparing that to the loan constant, you have positive leverage. I misspelled this. It should be an I. Now we have positive leverage. That explains why sometimes you might look at a deal, comparing the year one cap rate to the loan constant or the interest rate is giving you a negative leverage. But with a business plan, you can increase the NOI over time through increasing the revenue or decreasing the expenses and convert that negative leverage into a positive leverage. What if you paid all cash for that property? So the purchase price is $1 million. Let's assume the same revenue. Now you're paying all cash for the property. There's no debt on that property. Property level, everything stays the same. I'm just going to copy this down. The same thing applies here. If you paid all cash for this property without using a loan, now your net operating income becomes your cash flow because you don't have any debt service, so you're not paying any debt on that property. If you look at the cap rate on this property, it should be similar. The cap rate, which in this case is also your unlevered cash on cash, is 8.55%. So in order to determine if putting a debt on this property would help or negatively impact your returns, you would have to compare this cap rate to whatever interest rate that lender is offering. That lender is offering an interest rate of 6.4%, like we have in this initial example. Then the cost of borrowing is lower than your projected return on this property, which is 8.55%. That would be considered positive leverage. So when you're thinking about leverage, you're trying to assess, is putting a debt on this property going to help or negative impact my returns? Sometimes you might go into a deal with negative leverage, but by executing the business plan through increasing the revenue, decreasing expenses, which increases your overall net operating income, you can convert that negative leverage into positive leverage, as we've seen in this example. Leverage is a powerful tool in multifamily investing, but it's not a guaranteed shortcut to success. The key is to analyze every deal carefully, understand the relationship between cap rates and interest rates, and plan ahead for economy shifts. If you found this breakdown helpful, hit the like button and subscribe for more in-depth real estate insights. Drop your questions in the comments below. See you in the next video.